Welcome to the overview of money, banking, and the Federal Reserve System. This is Chapter 13 in the online text, Chapter 30 in the book. Thank you for joining me. Glad you're here. What are we going to look at in this chapter? We're going to look at the role of money, the role of how money works within the economy, how the Fed uses money in the money supply, how it creates money, how it takes money away, and how it uses commercial banks or private banks in order to do this, and how it conducts open market operations, which we'll look at more detail in Chapter 14 on monetary policy, but at least we'll get a good primer here on how that actually takes shape. So thank you for joining me. Let's look at money. We looked at the video in class of how money takes shape, the importance of gold, the importance of money being a character that we can use. It's divisible. It's an exchange. A medium of exchange. It's easy to transport, we hope. Gold, not so much, right? But the idea is it is in circulation, and we can use it for a number of different methods in terms of easily buying goods and services along the way that we're interested in. We use this as currency. And we can put it in a bank and use it as a checkable bank deposit in which people can actually write a check or use a debit card on it. And it's all part of the money supply. And we'll look at M1 and M2 here as well. So it is a medium of exchange. It's very easy to break down dollar bills. We know who's on the 100, the 50, the 20, the 10, the 5, and the $1 bill. We talked about that in class. So it is a medium of exchange in that it is easily identifiable and recognizable. It also stores value. $100 is will buy $100 worth of materials. Now that the value of those materials may change overnight, but the store of value for the money is we can buy $100 worth of whatever it is we want to buy each day, and that is a store of value. It's also a unit of account. We can look at this in terms of how we set prices and how we determine how much of something we can buy based on the unit of account here in terms of money. We haven't always had this type of money. What we have now is called fiat money. It's basically backed by the full faith and credit of the U.S. government. But we used to have commodity money in that the money itself was worth something. Think of gold coins as an example of commodity money. It has value in and of itself. You could melt it down and it would still be worth something. You melt down a dollar bill today, it's not worth anything. It is fiat money backed by the government that it is worth $100 of whatever it is you want to buy. Commodity-backed money was kind of what we had in between, and these were silver certificates, gold certificates, and they're basically dollars like we see today. But the difference here is that they're backed, commodity-backed money is backed by actual commodities, gold or silver, stored in a vault in the Fort Knox or in a Federal Reserve Bank somewhere. And that essentially is commodity-backed money. What we have today is that fiat money that you see down here, the Ben Franklin with the little the little piece of linen through it, or a holographic image in order to prevent counterfeiters. But that's what we see today, and it is fiat money, in that there's no commodity backing it up at Fort Knox. There's no additional resources behind it. It's not worth anything of value in and of itself, other than the fact that it represents $100 of purchases within wherever dollars are taken, wherever dollars are accepted, and that's what we see here. Now, how does the money go to the money supply and affect the money supply? Well, it becomes part of what we call a monetary base. The idea of looking at this money in circulation becomes a part of what we call M1. The idea that anything that is M1, and we'll talk about this in more detail here in a moment, but M1 is essentially cash and things that are very liquid, easily convertible into cash very quickly, and M1 is everything that already is in that cash. So traveler's checks take the form of use as cash. Checkable bank deposits, you write a check, it's essentially being used like cash. Near money is more M2. And much broader because it includes M1. But near money are other types of assets that can be easily converted, liquidated, if you will. And they're liquid in that they can be turned into money pretty quickly. It takes a little longer than a debit card or a traveler's check. But the idea is it is money in a near money sense. It can be converted. It just takes a little longer to do. And this includes things like money market funds, time deposits, savings accounts. it's easy to convert them. It just takes a little more effort than it would in the M1 category. So what we see here is M2 much greater because it includes M1, and it includes a lot of other types of money that we don't normally see. M3 is more used by investment banks and other institutional investors. We don't see that in the marketplace, but M1 and M2 we definitely see in the marketplace, and it includes these items that you see on the screen. As I mentioned, M1, very liquid, coins, currency, traveler's checks, the demand deposits. I can write a check on it and very easily get the money out of the bank, used as essentially as using a check as cash. Savings accounts, other types of deposit, time deposits or CDs, money market accounts, mutual funds, all of those are M2. I can convert those into cash, but there's an extra step involved, so it's near money, and that's the M2 category. M2 also includes M1, so it's always going to be greater in terms of what we see there. Now, we know investments, savings tend to be a lot of what we see in M2. People with their 401ks, 403bs, IRAs, and that sort of thing tend to be the savings that we see in the M2 category, more so than what we would see in M1 in actual cash. And that makes sense because most people don't have their cash hanging out in a bank account or hanging out in their wallet. They have it in other investments where it can earn them additional interest on the money and put the money to work for them. So that's traditionally what we see there. And over time, what we have seen is that M1 and M2 are both growing because there is more money in circulation, there are more people, and that the M2 is definitely growing faster in terms of that money out in the market, in terms of that space, and what we see there is that it is continually growing in terms of that. So what we need are people in order to help us manage that and control the flow of money. And it's not just the Fed that is going to do this; it is going to be banks. Banks have a significant role here. If you've ever heard the term "too big to fail," we definitely need banks in society. The Fed could not do what it does without banks in terms of helping to grow or slow the economy, and so they need banks in order to help them with this. And so banks play a really vital role here. For one, they act as an intermediary. When the Fed wants to sell bonds or buy bonds, when a consumer wants to buy or sell bonds, the bank is the intermediary between the Fed and these consumers or these institutions, even other institutions, investment houses and things. So a financial intermediary is really needed in order to do this, and we see that commercial banks play that role. When it comes to the banks, they do have to keep a certain amount of money on hand. We call this reserves. Now, there are what we call required reserves, or a reserve ratio, which is right now 10% that banks have to have on hand. And that means of the amount of money that you put into the bank, they have to keep that much money on hand. If I put in $100,000 into a bank, I make a deposit of $100,000, $10,000 of that needs to stay in the bank. That is in case somebody comes in and say, I want my $10,000. I need to make sure that I'm able to get that money back. Otherwise, it's going to dilute my confidence in this institution as to whether they're really keeping my money safe and whether the money is really there. Now, we know the money isn't really there physically. It's there on paper, but they're using this money to loan out to other people that are buying homes and cars and financing college educations and that sort of thing. But the idea is that the bank is the intermediary to make all of this happen. So looking at what we call a T account or a bank balance sheet, we see that both sides of this T account, you can see the little T there in between the assets and the liabilities forming a T. The T account or the bank balance sheet needs to be equal on each side. So assets need to equal liabilities. And we see this playing out in terms of loans that are being made out based on those deposits. So in this case, the bank has deposits totaling $1 million. They can make loans in the form of $900,000, but they need to keep $100,000 in reserves because of that 10% reserve requirement or that reserve ratio that is playing out at those banks. So important to note. That this balances. Notice they have $100,000 in reserves, they have $900,000 in loans, and $1 million in liabilities. Notice the deposits are a liability for the bank. Okay, they're not a liability for the consumer because they have put the money into the institution. It's an asset for the consumer or the company. But for the bank itself, for the commercial bank, it's a liability because that deposit is something they're going to have to pay people back. And so that's why they have to keep the reserves on hand in order to prevent a bank run. The last thing you want is for everyone coming in all at once and saying, I want my money out. I want my money out. And so, in order to prevent that, the Securities Act of 1933 basically said people that are running commercial banks need to keep 10% of reserves, and the Fed can change that number, can raise it, can lower it. That's the R in the bird toolbox. The R is reserves. They can change the reserve requirement to say that you need to have more money on hand or less money on hand in order to help the economy out. But what they're trying to do is prevent a bank run so that people don't come in all frantic trying to get their money out, and then the bank isn't able to meet those funds because they put money into a lot of other things. And we'll see how that plays out here in this chapter. But the concern is you want to prevent a bank run by keeping money on hand so that you can pay out those little demands for cash and have enough cash on hand to be able to do that. And that is a requirement the Fed has for institutions. Now, there is a moral hazard associated with this in terms of these requirements, and that is because all banks have to have deposit insurance. The Securities Act of 1933 also said that if you're going to open, you have to have deposit insurance that at the time insures each account for a consumer or a company account up to $100,000. Now, today it's $250,000, this insurance. The FDIC, or the Federal Deposit Insurance Corporation, that is run by the government, basically oversees this money, this insurance package that each bank has to make sure that their bank is insured by the FDIC and meet all of the FDIC requirements in terms of bank examiners and that sort of thing in order to address this. But it does create a moral hazard. If you have deposit insurance, will the bank be more likely to take riskier investments on because they know that even if they fail, the government's going to bail out all of the depositors, and so the people will get their money back anyway. So it is a dangerous dilemma. But the federal government has sided on the idea that they don't want another 1929 to ever happen again, and deposit insurance is a way to help prevent that. Now, banks are also required to keep a certain amount of money invested in capital, in their assets. And so they have to have about 7% or more of their assets in terms of capital that they have that they have skin in the game, that they have investments in the assets that they hold. And about 7% of that is banks' capital. So they have to have skin in the game too. Otherwise, it would look like, hey, what kind of operation are you running here? You don't have any investment in this, so you don't really care whether the money comes and goes or whether the money disappears. And that is of concern to investors. So capital requirements say, hey, if you've got to have certain capital invested in this business, that makes me a little more confident that you're going to be more careful in taking care of my money as well. And that really is where that capital requirements is coming from. Now that leads to reserve requirements, which is a little different. This is basically saying that of all the deposits that you have in the bank, a certain amount, and right now the amount is 10%, needs to be kept in the vault in case to prevent that bank run we were talking about earlier. So a reserve requirement can be raised or lowered in order to grow or slow the economy. But the idea is, and that's the R in the bird strategy, the monetary policy that we'll talk about in the next chapter. But the idea here is that reserve requirement prevents a bank run. It prevents a lack of confidence by consumers and other companies to get their money out now before there's no money left. And now we know with deposit insurance that's less likely, but the idea there is a reserve requirement does help to mitigate that by making banks accountable to how much money they have to have on hand at any one time, and to meet that requirement on a daily basis. At midnight, they have to meet their reserve requirements. If they don't, if they fall below that 10% threshold in terms of having enough money in the vault to meet that requirement, they can do what's called taking out a loan at the discount window. It's also called the overnight window because, again, the deadline is usually midnight when they count up the money and have to report how much money they have on hand in cash in their reserve requirements and versus deposits to make sure that they meet that 10% reserve requirement cap. And so if they don't have enough money, they can borrow money from the Fed in order to meet that requirement from this discount window or the overnight window, and they pay what's called a discount rate or an overnight rate. Now, this is the D in the BIRD strategy of the monetary policy toolbox that the Fed has. Right now, it's at 0.25%. Before the pandemic, before the coronavirus, it was 1.75%. So you can see how much they've lowered that discount rate in order to encourage banks to borrow money. And what does this do? Well, it encourages banks to make loans. It encourages banks to make loans to the community, to encourage the community to take on loans and to get money flowing out into the economy to encourage the growth. If you don't do that, then there's less likely that multiplier we talked about before, the spending multiplier, there's less likelihood that people out in the marketplace are going to spend money and it's going to help grow the economy. So the discount window is designed to give the banks an out. If you can't meet that reserve requirement because you made too many loans today, you can borrow money at a really cheap rate from us, and then we'll help you meet that reserve requirement overnight, and then you can pay the money back to us and continue to make your loans out to the community. And that is a really great strategy for banks because they can borrow pretty cheaply, as you can see here, 0.25%. I wish my mortgage was 0.25%. And then they can charge more when they make those loans and actually make money off of the money they're borrowing from the Fed, and that's exactly what they do. So it's beneficial to the banks and encouraging the banks to do that. Now, if they raise that rate, that would discourage banks from doing so, and that would be designed to slow the economy down. In a recession like the one that we're looking at with the coronavirus pandemic, the idea there is they want to lower that rate as much as possible because they want to encourage the growth. They encourage the growth to create jobs and get the economy moving again. Now, what impact does that have on the money supply? Well, if you look at the bank, essentially before the bank makes a new loan, they have $1,000 in deposits. They don't have any loans yet, but they essentially have $1,000 in assets. Those are liabilities on the other side, but again, they do have to balance. So what we see here is they have $1,000 in cash. It is in reserve. They don't have to keep it all in reserve. Remember, only 10%. So $100 would stay in reserve. $900 could be loaned out. It's still an asset. But they still owe the depositors $1,000, and that would still balance in terms of what we see here. So, what is the change? Well, in this case, if we have $900 in reserves and we make out loans for $900, we're seeing that that there's no change to liabilities, and the assets have basically canceled each other out. So there's no change on the asset side either. So they do equal. 0 equals 0, essentially, in this model. Now, how does this impact the economy in terms of getting the economy growing again, in order to grow the economy, to create money like we're talking about here? Well, what it does is it basically takes that $1,000, and let's say in the book, Krugman talks about this guy named Silas. Silas had money under his bed to the tune of $1,000, and somebody convinced him to go take the money and put it in the bank. So he did. He went to the bank, he took the $1,000, he put it in the bank, he took it out from under his bed, where it was obviously worth less today than it was yesterday, because we know time value of money is a dollar today is worth more than a dollar tomorrow due to inflation and other reasons behind it. We'll get to more of that in Unit 5. But the idea is he put $1,000 in the bank. The bank then takes that money. They have to keep 10% on hand in required reserves, but they can loan the rest out. And so they are creating $900 additional dollars of Silas's $1,000. Essentially, they still owe him $1,000, but now they're going to take the $900 from his money and loan it out to Mary. And Mary's going to get $900 for whatever she wants to buy, whatever she wants to invest in. She's going to deposit that money in the bank, and then we're going to take 10% out of that and then loan out the rest again. And this is over multiple times that this is happening. The bank is creating money. And the Fed is essentially creating this money by encouraging banks to do this, by encouraging banks to meet these community needs by creating more money. Now, the reserve requirement, by keeping it at 10% and not raising it to 20%, the Fed is encouraging banks to make more loans and to loan out this money. Now, if times were really bad, and this is the scenario that I call break the glass, pull the fire alarm, the Fed could lower the reserve requirement to 5%, for instance, cutting it in half, and that would encourage more loans to be made out to the community because they didn't have to keep as much money on hand. So if it were 5%, instead of keeping $100 of Silas's money, they would only have to keep $50 of Silas's money, and they could loan out $950. And that, again, is going to encourage more growth in the economy, more growth to get things moving again. So the number I want you to focus on in this graph is the idea of 2,710, because just in two scenarios, what we played out here was Silas's $1,000 that he had under his bed was only $1,000 in the money supply. But when he deposited it in the bank, and we see this start to play out, what we see is it is a money multiplier. It is basically creating additional money based on the $1,000 he had. And just in two scenarios played out here, we saw the loan to Mary and the loan to Anne. We've created $2,710 in the money supply from the $1,000 that he started with. Okay, and that's how money is created by banks through the Fed's reserve requirements. Okay, so the money multiplier is essentially a very simple formula. It's 1 over RR, and what it does is it tells us whatever excess reserves you have beyond the requirement, you can loan out, and you can do this to help create money and grow the economy. And they're going to make money off of every loan that they're making. So by taking Silas's money and loaning it out to Mary, and then a smaller amount to Anne, and then another smaller amount to Julio, and another smaller amount to Fred, they're creating money as part of this. And the money multiplier is the formula we use, 1 over RR, which tells us what is the ultimate effect of this $1,000 that Silas deposited. And 1 over RR, which is 1 over the reserve requirement, in this case 10%, so 1 over 0.1 or 1 over 10%, is essentially what we see a multiplier of 10. So 1 over 0.1 essentially is a multiplier of 10. Multiply that 10 by Silas's $1,000, and you can see ultimately it creates at the end, from Silas's $1,000 until the end of seeing that play out through this money multiplier, it created $10,000 worth of money. Okay, $10,000 worth of money in the money supply as a result of Silas depositing that money. Now remember, he had it under his bed where it was only $1,000 in the money supply. Now it's $10,000 because of the money multiplier, and that adds to the money that is out there in the money supply. Okay, the monetary base is the idea of if you've got currency in circulation and what you've got in reserves. So that's including the money that's out there in circulation and the money that you have in the bank, right? The money multiplier then is looking at the money supply, which is going to be including all of the things like checkable bank deposits and the money that's created as part of this money multiplier. Okay, so this money supply with the monetary base. In reality, we like to think that, the money multiplier of 10 works its way out into all of these things. What we forget about is what we call leakage. The idea that people are going to spend the money. I mean, Anne and Mary, they are going to spend the money along the way. They're not borrowing the money just to put it in the bank so the bank can loan it out to somebody else. They are looking at spending money. And so we get leakage in terms of, hey, I want to spend $100 here. I want to spend $100 there, or $50 here, or $20 there. So that's creating some leakage. And so the reality is, while the money multiplier is 10 in this scenario, it really is more like 1.9, because the idea is that it's not having as great of an effect on this because of leakage, because people are spending parts of the money that they're getting in those loans from the bank. They are going out and spending that money. And so what we're seeing is it doesn't have as great of an effect, but for purposes of what we're looking at in macroeconomics, we're looking at the idea that it is a multiplier of 10 based on that 10% reserve requirement. We can see that a lot of money has been created over the last 10 years since the financial crisis of 2008, 2009. A lot of money in that monetary base, an explosion of money in the money supply as part of that, and even more so since the pandemic hit, in terms of the Fed really trying to grow the monetary base, encouraging banks to go out and make more investments and to do so, and you can see the explosion of the monetary base and the money supply as a result of what we see here. Now, the question is, so what is the Fed's role in all of this? How does the Fed, we see what banks are doing to create money. What's the Fed doing on their side of things in order to help grow the economy or slow the economy down? So let's take a closer look at the Fed before we close out this chapter in looking at what the Fed can do. Now, the central bank is a common term used for the Fed or the Federal Reserve, also known as the Federal Reserve Board of Governors, the Federal Reserve Bank. A lot of those are used interchangeably. There is a bit of delineation, not as much you need to know here in AP Macro, but there is a delineation in terms of them. The central bank that we're talking about is the Federal Reserve. It is made up of the Board of Governors in Washington, and the Federal Reserve banks are all of the 12 regions that we see across the country. They are made up of bank presidents that are nominated by the President of the United States with confirmation by the Senate, and each of those serve in their respective cities that you see here. So for Region 12, the Federal Reserve Bank of San Francisco is based in San Francisco, and the president of the Bank of San Francisco is going to oversee that entire region from Hawaii and Alaska to the Northwest states all the way down to Arizona and Southern California. So the people that work for the bank president, the Federal Reserve Bank of San Francisco, are going to be reporting in on what's happening in businesses and consumers and inflation and unemployment, and businesses closing or opening and what's happening. The Federal Reserve Bank president of that region is going to be talking to people and business owners and consumers and workers throughout the region. And then they're going to take that knowledge and what they've learned back to the Board of Governors in Washington. And they do that 8 to 10 times a year. They just had one this week, actually. They met on Tuesday and Wednesday. And much of it by Zoom right now because of the pandemic. But the idea was that they met in order, and they do that 8 to 10 times a year in order to talk about what's going on in the economy, what do we need to do? And so it's the what do we need to do that we focus on with the Fed. And a lot of that is monetary policy that we'll talk about in Chapter 14, which is the next chapter, Chapter 31 in the book. But the idea is there are some things that the Fed can do in their toolbox in order to address the needs that the country has, whether it's to grow the economy out of a recession, like we're dealing with the pandemic, 10 million people out of work, or whether it's to slow the economy down, concerned about an inflationary gap or a positive output gap that is leading the economy to be too hot, so which we don't want either. So one of the ways that they do this is by looking at what we call the interest rate or the federal funds rate that's out there. The Fed can essentially raise or lower this rate, and this is the rate that banks are charging consumers and businesses, companies, to borrow money from the bank. The bank can't charge any less than this. They can charge more, but they can't charge any less, and it's designed to encourage competition among the banks in order to find ways to be competitive, but not to give money away. Now the Fed has this is pretty low. This was before at 1.5%, 1.25% before March of 2020, and ever since then, for about a year now, it has been at 0.25%. So pretty low. How low can you go? Well, not much lower. And they usually do it in 25 basis points or 0.25% at a time in terms of what we see here. So if they're going to raise it, they're going to do it by 0.25%, or if they're going to lower it, 0.25. Sometimes 0.5, depending on how inflation is doing. But a lot of times it's 0.25% at a time. So this is the rate that consumers are using to, this is the rate that banks are using to loan out to consumers, and they're usually going to charge them more. I wish I could get 0.25% on a mortgage. That would be just dandy. But there's no way. There's no way that happens. I mean, you'd be doing good to get 2 3/4 or 3% right now. And that shows you where the bank is making money. Between what the Fed requires that they charge, 0.25%, and 3%, that's where the banks make their profit. by loaning that money out at a higher rate than the Fed is charging. Now, if the Fed raises that rate, that obviously affects all of the banks' rates in terms of what they're charging people. And if they lower that rate, that also has an impact. But the Fed has a lot of power here in terms of what they can do with that rate in terms of impacting the market. So if they want to grow the economy, they're going to lower that rate. If they want to slow the economy down, they're going to raise that rate. And what it does is it encourages and discourages, respectively, banks from making loans. And so if the rate is lower, then the bank can loan more money out. And they don't have to worry about that reserve requirement because if that reserve requirement is lower, then they can make more loans. If the discount rate is lower, they can make more loans and borrow money from the Fed overnight in order to meet their reserve requirement and still be making the loans and making more loans, which encourages more money to flow into the economy. And that's really what the Fed is trying to do in that situation. Now, if they want to slow the economy down, what do? They raise rates, right? And by raising those rates, it discourages banks from making as many loans as they would have if the rates were lower. It also discourages consumers and businesses from borrowing at higher rates. Who wants to borrow at a higher rate? I'd rather borrow at a lower rate, not a higher rate. So that is where using the rate really makes a difference in terms of growing or slowing the economy. Now, what impact does this have on open market operations? This is the idea of changing the monetary base by buying or selling bonds, buying or selling debt, treasuries, T-bills, securities, U.S. treasuries, whatever you want to call them. They're used by many of those names, but they're all basically the same thing. They're buying bonds or selling bonds. And these are basically IOUs from the federal government saying, we owe you money, we're going to pay it back, we're going to give you X percent on your money as well as your money back when this matures, when this time period ends, and we're good for it. So mark our words, we're good for it. Here it is. And so that's the open market operation that we see the Fed undertaking. Now, they're going to buy bonds. And essentially, in this buying and selling of bonds, what they're doing is they're adding, if they're buying bonds, they're adding money to the monetary base. So what you see here is a liability in terms of buying those bonds. It's an asset that the government has, the Fed has in terms of treasuries, and they're going to offset that with liabilities in terms of the currency that's out there. By buying it and putting money, mind you, money that they don't have, but if they're taking these treasuries and buying them back, they're giving banks money for those treasuries. So they're taking the treasury back. The treasury is an asset, and the money that they're paying it with is money that's going out into the bank to be loaned out to consumers and businesses and companies and other people that are borrowing money from the bank and will pay that back. And again, the idea there is they're going to deposit it, and it's going to have money creation on top of what we're looking at there with the money multiplier. It's going to have even more of an impact in terms of how much money is out there in the market. So one of the ways to think about this is in what we call buying to grow and selling to slow. On the left-hand side here, you see the Fed is going to buy treasuries. The Fed buys the treasury, so a bank gives the treasury to the Fed gives the money to the bank, and then the bank is going to use that money to go out and make loans with it. So instead of holding on to that treasury, the bank then has cash that it can then use to create more money, to go out and make loans to companies and businesses that are going to spend that money in the economy. That's going to help grow the economy, and that's why we buy to grow when it comes to bonds. So buy bonds to grow the economy. And then on the right side, we're going to sell bonds to slow the economy down. So on the left-hand side, we looked at it in terms of how do we get out of a recession? Well, we buy bonds. We put money in the economy. In the right side, we're selling bonds to slow the economy down, to take money out of the economy because there's too much out there. We're worried about inflation ruining our economy and leading us to a recession because prices are too high. So we're going to sell bonds. What's the bank going to do here? Well, the bank is going to essentially give the Fed money in order to, because the Fed is selling these T-bills, these bonds to banks. So the Fed gives the T-bill to the bank gives the money to the Fed, and then the Fed is basically taking money out of the economy. Well, what are people going to do if there's less money in the economy? They're going to spend less. That's going to keep inflation from rising out of control. And that's how the Fed sells to slow the economy down in terms of what we see there. So by using bonds and interest rates, B and I in the Bird toolbox, two of the most important aspects, they're using this to slow the economy down or grow the economy, depending on which situation they're in. So buy to grow the economy, sell to slow the economy. They're going to lower rates to grow the economy. They're going to raise rates to slow the economy down. And we see this time and again with that federal funds rate we were just talking about. Notice in 2020, it dropped precipitously, and it's been pretty low ever since. And the reason for that is obviously trying to grow the economy out of a recession related to coronavirus. And so we've seen it all over the place. Look at those federal funds rate numbers in the 80s, pretty significant. Really worried about inflation. What they found was that the Fed, with monetary policy, needed to work with Congress and the president on fiscal policy to get a handle on this, to get a handle on debt, to get a handle on spending, to get a handle on interest rates, and kind of how do we work together in unison to try and collaboratively keep the economy humming. So we've learned a lot of lessons from that decade in terms of from the late 70s into the early 80s in terms of how to grow and slow the economy. Now, what impact does this have in terms of these buying bonds and selling bonds? So in this case, we're buying bonds by the Fed. So this is looking at it from a T-chart from the Fed and a T-chart from the commercial bank. Well, what the Fed is doing here is it's basically saying, well, we've got treasuries and we've got money in assets because we're creating this cash. So we owe it to the monetary base by putting the money out there. And we're doing that to the tune of these treasury bills, but also to the tune of the $100 million that we're going to owe, because essentially we're creating money in order to buy these treasuries. Now, the commercial bank is essentially going to be selling these treasuries. So it's $100 million out of their assets. But what are they going to get in return? They're going to get $100 million. So their net is going to be equal assets, equal liabilities, and the Fed's is too, because the idea here is that the Fed is going to be buying those bonds, going to be using money in the monetary base to do so, and the commercial bank is going to sell those bonds to the Fed. Fed's buying them, and is going to get $100 million in return that then they can use to grow the economy by making loans out to consumers and companies and businesses in order to make that happen. Lastly, an open market sale, selling bonds in order to grow the economy here, is doing the opposite. And this is by selling bonds. Essentially, the Fed is taking these bonds and selling them to commercial banks. This is going to be an asset for the bank. It's going to be a liability for the Fed in terms of the money that's out there. But the Fed then is going to have essentially by selling these bonds is going to be picking up cash that they're going to be including in the monetary base. They're going to be holding on to that cash in terms of what we see here. So they're taking money out of the monetary base, taking money out of what they would normally be buying, be using the money to buy with, to buy treasuries with, and taking that money out of the economy. That takes money out of the economy, which takes money out of the hands of banks, which takes money out of the hands of consumers and businesses, and it's going to try and slow the economy down because there's not as much cash out there. If there's not as much cash, people are going to be more reluctant to go out and spend things frivolously on all kinds of crazy things and drive up prices. And that really is what the Fed is looking at there in terms of open market operations to slow the economy down. And that's what they look at when they're trying to slow the economy down to keep inflation at bay. And we saw this in the 80s. We saw this in the 90s. and in order to try and keep inflation in check. We've definitely learned a lot of lessons from those periods in time from an economic perspective. All right, so some additional resources as we close out the chapter here. One thing to cover is there's a really good clip from ACDC Econ on that creation of money that we talked about, the idea of the money multiplier, 1 over RR, in terms of addressing it. There's also a clip here taking you through the money multiplier that we did just now in the video, looking at Silas's $1,000. They look at something here too with Bob and Jill in terms of making that happen. Looking at the bank balance sheet, some notable terms, and then a couple of practice sessions for you to kind of look here, and then you can look in the speaker notes to find the answers to the bank balance sheets in terms of how this plays out. So a couple of practice exercises, and also the take-home quiz is going to have some exercises in there for you to do as well. There's also some explainers on these videos that I think you'll find helpful, and from Khan Academy, ACDC Econ, Jason Welker, and others that I think you'll find helpful here too. Also, you can check your work on the take-home quiz in terms of any questions you might have to address that there. And always, as always, email me if there's something that you're stuck on that I can help with. I'm happy to do that. And that essentially closes out this chapter on money, banking, and financial institutions and the role of the Fed. Now we'll look in much greater detail in the next chapter on monetary policy about what we call the Fed's BIRD toolbox, how it uses BIRD, bonds, interest rates, reserve requirements, and discount rates in order to grow or slow the economy. And we'll see you in class when we take a look at that next chapter. Good luck on the upcoming assessment, and I hope you found this helpful. As always, email me if I can help if you have questions.